Hey everyone, me Kevin here. I believe the Fed is playing psychological warfare with us, and what they're doing might actually succeed. And it's worth knowing exactly what they're doing and what they might secretly be planning on doing, because it could affect our investment style going forward. Alright folks, let's get into this video. Keep in mind, there are some amazing programs on building your wealth and some amazing perspective on building your wealth in the programs linked down below. Use that 40% off coupon code. Alright, let's get into this. First, we're going to do facts, then we're going to do conclusions. We're going to talk a little bit about my opinions after that. So, fact number one. We know that the Fed does not believe long-term inflation will occur. This is important because as much as we think longer-term inflation might occur, it's worth noting what the Fed believes. We know this because of their summary of economic projections, which they do not release every time they do a meeting. I think it's only 6 times a year. Actually, it might only be 4 times a year. I've got to fact check that. But either way, take a look at this. We know that their projection for inflation, which is right here, it only hits a high of 3.4% for the end of this year. And in 2022 to 2023 and into the longer run, right here, between 2 and 2.2%. That's it. So we know the Fed does not actually believe there will be a longer run inflation. We know this. Fact number 2, we know that Jerome Powell has acknowledged higher near-term inflation and that more Fed officials are expecting a rate increase sooner rather than later, either at the end of 2022 or multiple times in 2023. In fact, the Financial Times reported that markets appear to be pricing in as much as 4 rate hikes in 2023. We also know that Federal Reserve President Bullard from St. Louis this morning on CNBC argued for a rate hike as early as the end of 2022. Now, it's also worth noting the movement in the dot plot. The dot plot, this is, oops, that's not the dot plot. There we go. The dot plot is right here. We've also noticed that many more Fed officials have the opinion that rates should rise in 2022, not just Bullard, but 7 in total compared to 4 previously believe that rates should go up in 2022. And now 13 versus 7 previously believe that rates should go up in 2023. And we're also seeing these dots start trending higher. But you notice they all consolidate around 2 to 3% for a Fed funds rate and around 2.5% for the long term. Now, this is also interesting because if we jump on over to the projections that we had in March, which was the last time we got a summary of economic projections, and we jump on over to the rates, we can see that they've always kind of been relatively consistent here between 2 and 3% for where the Fed funds rate should be. So this hasn't changed much. Their overall belief is that inflation will sit right around that 2 to 2.1% level, and that the Fed funds rate should be somewhere between and around 2.5%. Now, fact number 3, and we touched on this yesterday, but it's worth an update. The 5-year to 30-year Treasury curve has continued to fall today, suggesting again and reiterating slower growth in the near term, and again suggesting a flight towards growth and away from recovery or value. Now, this is evidenced by the latest chart that we have on exactly this. Which, take a look at this. If you look at the day chart, thanks to Bloomberg for this, but look at the day chart right here. This is the curve between the 5 and the the 5 and the 30 year, and we go ahead and see this sort of plummet leading up to the meeting. Meeting occurs, plummet yesterday, and then today we've plummeted even further. So looking at this on a 1-month scale is pretty dramatic and pretty damning. The shift is very, very evident, and so this is important to know. So that's fact number 3. Fact number 4 has to do with something known as the skew index. Now, the skew index measures the volatility of pricing between options, calls and puts. And usually when the skew index is at all-time highs, which it presently is, it suggests dramatic volatility coming in the next 30 to 60 days. So this is another fact that we want to pay attention to. The next fact, fact number 5 we want to pay attention to, is that long-run inflation expectations for May 2022 came in at 4%. This is much higher than what the Fed expects. Remember, fact number 1, we talked about what the Fed expects. They expect to see inflation in the long run be between 2 and 2.2%. Well, consumers, society, believes inflation next year, May 2022, will come in at 4%. It's a much higher expectation. The 10-year inflation expectations, based on the survey by the University of Michigan, which is generally what we look to, or who we look to for inflation expectations, finds that the 10-year inflation expectation for May 2031 is 2.8%. Also, much higher than what the Fed expects. So both the shorter-term inflation expectations and longer-run inflation expectations are much higher than what the Fed believes will actually happen. Fact number 6, expectations of inflation can actually affect inflation. This is a psychological trick, and this is going to be the basis for the psychological warfare that we're going to talk about with the Fed. But here's how this works. If we expect higher prices in the future, we're more likely to buy now. This makes sense. If we think graphic card prices for our gaming computer are going to go down over the next 6 months, we're inclined to wait. If we think they're going to go straight up over the next 6 months, we're inclined to buy now. Well, the inclination to believe that prices are going up can lead to more demand pressure now, which basically compounds on top of the existing problem we have, which are supply chain issues. So high inflation expectations potentially lead to more demand stacking on top of supply chain disasters, helping essentially push prices up together, fulfilling a self-fulfilling cycle of inflation. So that's how psychology affects inflation. And then we have fact number 7. And this is that high inflation expectations and high inflation are both generally considered bad. So two different things, right? Expectations and actual inflation, both of them are considered bad. Because when high inflation comes, high inflation tends to hurt consumers most. They also hurt businesses, but they disproportionately affect less wealthy individuals with more consumer debt as opposed to asset-based debt. Assets, of course, can go up with inflation by riding on top of the inflation curve, but it's usually folks with student loan debt, credit card debt, car debt, or other really non-asset-based debt who end up getting screwed. Now, I understand that sometimes cars can be deemed assets, but let's be real. Generally, 99% of cars that are out there go down in value. So I don't like to consider them asset-based debt. They're more of a consumer debt. And I understand we can have a debate about that. But now we have these 7 facts that we've set up on the Fed. We've talked about the skew index. We've talked about the 5s and 30s, about how this chart is plummeting while the skew index is at all-time highs. We've talked about the dot plot and how the Fed does not believe that we are going to have long-term inflation. We've talked about long-run inflation expectations and the psychological impact that inflation expectations can have on actual inflation. And we talked about how inflation is bad. So where's the psychological warfare part come in? Ah, yes. Let's talk about this. So here's the thing. My conclusion, number 1. The Fed doesn't believe that we'll have long-run inflation. We know that. So it appears to me that the Fed's hawkish meeting on Wednesday may be an attempt to manipulate the market to inflect downwards their inflation expectations. Consider this. When the Fed ignores the present inflation we have, we lose trust in the Fed. The Fed creates more uncertainty because people believe that the Fed is hiding true inflation and that inflation is actually worse than it appears, making the Fed lose trust. Alternatively, if the Fed does like they did on Wednesday and they come out and acknowledge that short-term inflation is much higher than expected, but at the same time stating that they still believe that longer-run inflation will align with their long-term expectations, then we all of a sudden ease the fears that the Fed is hiding something from us. Instead, it makes it feel more like, okay, the Fed just underestimated. They came clean about their mistake. Okay, can we now get back on the same page and no longer fight the Fed, but instead align with the Fed? Well, right now it appears that the market is actually aligning with the Fed. Now, you might not believe the Fed, and that's okay. Like, you may be watching this going, I still don't trust them, okay? That's okay. That is okay. You are right to believe that. But take a look, folks. The market is buying it. 30-year Treasury bonds, folks. 30-year Treasury bonds, straight down after the Fed meeting. Here, I'll remove myself so you can actually see it. Straight down on the 30-year. Let's go to the 10-year, which is obviously longer. Initial fluctuation up leading into the meeting, down after the meeting, continuing this monthly downtrend that we have in the 10-year. Though the 10-year is a little bit more mixed than the 30-year, which makes sense because it's closer to the short term than the long term. And then, folks, the 5-year, boom, straight up. Which, wait a minute, that is exactly the alignment we're expecting. We're expecting, based on the Fed, what the Fed said, we're expecting the market. If the market wants to align with the Fed, then we believe inflation will be higher in the short term, making 5-year treasuries less desirable, meaning people are selling 5-year treasuries. And I know this gets confusing, but when people sell the 5-year treasury, the yield goes up. And instead, people shift into longer dated bonds like the 30-year. And when people buy more of the 30-year, the yield goes down. So right now, the stats, the charts, and I've spent the last 7 hours diving in on this. I really enjoy this. I also like providing you these short, under 15-minute summaries because it's a lot to digest. But to me, my bottom line conclusion, number one, which you got more conclusions, but my number one conclusion is the Fed is successfully molding, some might say manipulating, the market to align with what the Fed believes. And the market is buying it. The market didn't believe the Fed before. Now the market's like, okay, all right, y'all just effed up. Okay, no problem. Oh, okay, we should be aligning that way. Okay, all right. It's literally what's happening, okay? Conclusion number 2. And this was brought to us by Bloomberg this morning, so credit to Bloomberg. And I've been studying this again throughout the morning here. It's possible, and there's starting to be murmurs of this, and these are just murmurs, so this is, I would say, a little bit of a weaker conclusion, but it's still a conclusion. It is possible that the Fed may actually be coming on too strong, as it often does. Consider when they came on too strong in 2018 and crashed the real estate market by dropping prices 12% month over month. I know, because it literally punched me in the face. But we also know that we can actually lead, or this sort of hawkish behavior, rather, could lead to lower inflation than expected. That is, the Fed might be overly hawkish and end up reducing inflation expectations, which we're already starting to see, especially longer-term inflation expectations, chillaxing people about inflation, then doing the opposite of what we talked about earlier. Oh, okay, well, if inflation is going to be less of an issue, we kind of rotate down on inflation expectations. And then what happens? Well, you rotate down on inflation expectations. People, there's no pressure anymore to buy now. And all of a sudden, demand actually wanes. Supply chain pressures are able to ease and resolve themselves. And oh, crap. Everything that was actually pushing inflation up now vanishes. This is like kind of Inception-esque. It's crazy. I mean, think about it. Inflation is high now. People are freaking out or have been freaking out about inflation. The Fed comes out, finally acknowledges high inflation, says they're going to adjust short-term forecasts. Now they're coming in so strongly that the market is responding in such a way where the market's like, okay, wait a minute. Let's change our expectations. And now if expectations fall, we undershoot inflation targets, meaning the Fed might literally in the future, like within the next 2 years, might cut bond purchases, cut QE, right? And then raise rates, only to in a couple years have to reverse and potentially lower rates again and increase bond purchases or QE again, quantitative easing. Now, we don't want to project all of that kind of flippening at the Fed, but it's very interesting because these two conclusions together paint a very clear picture, in my opinion, at least. Hopefully it doesn't sound confusing to you, but to me, it's a very clear picture. One, the market is aligning with the Fed's belief that inflation will go away, but that short-term inflation is the big problem. And this could potentially lead to an overshoot by the Fed to react too soon. And really, what ultimately happens is the market ends up slowing down a little bit. This big growth after the V-shaped recovery starts flattening out, and we end up getting certain sectors blowing up more than others. Personally, I look to one of the most downbeaten sectors we've had over the last 6 months, and quite frankly, it's been tech. It hasn't been crypto, it hasn't been recoveries, it's been tech. Tech is pretty dang beaten down. Now, don't get me wrong, I understand that crypto is down, and I'll have a crypto video coming out soon to explain my thoughts on crypto. But take a look at this. We talked about the market like this yesterday, and we saw this happening yesterday. Look at the market again today. Let's start with the losers. So in losers, we have some moment. Arrival was really a brief momentum pop here. But what do we have falling? A REIT, Ashford Hospitality. We're going to ignore the crypto-related stocks for a moment. We're going to focus on actual non-momentum stocks here to get an understanding of what's going on. And this would be things like Levi, U.S. Steel, commodities, right? We've got Teradyne, an industrial, Microvision, we've got a lot of momentum in here, and I understand that. Corsair Gaming, very low multiple, falling. We've got Seagate Technologies falling, Walgreens falling, Poshmark is in here, EXPI falling. We got Roblox, Nordstrom, DraftKings, JP Morgan, Beyond Meat, Root, Tattooed Chef, Build-A-Bear, Western Digital, Marriott. You've got Wendy's here, GameStop, Simon Property Group, Disney. The vast disproportionate amount of what's falling today, including Trimble, another industrial here, are industrials and recoveries. Spirit Airlines, Dave & Buster's, sort of day 2 of this. A lot of Dow-style industrial stocks falling. The ones that are doing very well today, ironically, maybe unironically, are things like, look at this, DocuSign, Roku, Lemonade, ChargePoint, Zillow, DoorDash, NVIDIA, PayPal, Shopify. We've actually, for some reason, got Delta in the mix over here, which kind of skews this a little bit. But anyway, Netflix, Square, Snowflake. The vast majority of the companies that are doing very well right now are actually the higher multiple companies. So we can actually go even deeper than just saying tech. It's actually the higher multiple companies. Because if you consider Apple and Google, those are lower multiple companies with potentially less growth forecasts. You look at a company like Lemonade, it has like an infinite PE ratio because it's not profitable. DocuSign, not profitable. It's literally up. I mean, golly, 10, 20, it's probably up 30, 45% over the last month. I remember saying, oh my gosh, DocuSign is under 200. What a deal. Enphase. A lot of these higher growth companies, Square, PayPal, Tesla, the higher growth companies are doing very well right now. So this is actually a little different from what we talked about yesterday, where yesterday we were saying it might be tech overall, but specifically today and yesterday, we're seeing the market really favor higher growth potential, higher PE stocks, higher multiple stocks, as the market preps for a potential broader slowdown and a trade or rotation away from reflation stocks like recovery stocks and value stocks. Kind of interesting. Some fascinating trends. I don't know how long this trend will hold. The market can be very, very fickle. We're expecting a lot more volatility. We've got triple witching and so on, whatever, big deal. Volatility doesn't necessarily mean price directions go in our favor or against our favor. It just means more people are trading. It's not a single easy catalyst that we can use. But what we can say is the market's moving. And right now, it appears to be moving to align with the Fed. And so anything we can do to understand what the Fed is doing is going to be very, 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 very important for our investing choices. So if you want more of these insights, consider checking out the programs linked down below. Consider checking out those stocks and psychology of money programs. We've got a ton of new lectures coming. Real estate investing group, the YouTube how to make money online group. Many options for you linked down below, folks. Thank you very much for watching this video, and we'll see you in the next one.